In today's video, I'm going to talk about a few aspects of trading with highs and lows in the chart and how to understand the current trend of the market in a simple way. In my opinion, the best way to discover what's going on with buyers and sellers in any market is by observing the highs and lows and some specific situations that happened when we analyze one market extreme in light of the other. In this example, I will show a market scenario that happened in the Australian dollar versus the US dollar in the 15-minute time frame, but you can apply the same rationale in any market you want and in any time frame. Highs and lows are important because they highlight moments where the supply and demand balance got extremely tilted to one side of the market. For example, in a market high, there is too much supply and very little demand, so price naturally starts to come down. In a low, there is too much demand and very little supply, so price naturally rises. One interesting aspect about the market is that it has a short-term memory window, meaning that the market remembers recent points where supply and demand went extremely unbalanced. This can be used to forecast future points where price might react again. There's a possibility that buyers and sellers will react to previous highs and lows. However, it's not that simple because highs and lows are not classified in the same way, and they can mean different things in different market scenarios. This is where the notion of trend comes in. When we have higher highs and higher lows, we can say that we have an uptrend, generally speaking. When we have lower highs and lower lows, we can say that we have a downtrend. This counterpoint between highs and lows in their respective trend will set the tone for the trader's expectations about such market extremes. That's precisely what I want to show you in this video. Notice that in this market, it's very easy to spot we have higher highs and higher lows, meaning that we have an uptrend, roughly speaking. Just as a parenthesis, you have to keep in mind that markets are not always this simple, and in most cases, you'll find more than one flow happening at the same time, which will make the trend identification process trickier. For this example, we are just examining one flow. This idea that higher highs and higher lows form an uptrend comes from a logical intuition about buyers and sellers. If buyers can surpass the last high they created at the same time, they prevent sellers from generating new lows. It means that buyers are stronger than sellers in general. It's as simple as that. Here we also must recall the notion of supply and demand zones. In a real market like this one, buyers will typically not retrace all the way back to the last low to initiate the next movement. They will retrace to the demand zone in this case. In the fractal flow jargon, the upper and lower limits of a zone are defined by the inward and outward frequency lines that appear in the transition between two opposing price vectors. In this chart, we have an interesting situation. I marked out the last two demand zones, which are places out of which buyers created upward price vectors. In the first zone, buyers were able to create a higher high after leaving the zone, but notice that this doesn't happen in the second zone. Even though the second zone is indeed a demand zone, since it creates an upward price vector, notice how buyers failed to surpass the previous high. In terms of market logic, this means that buyers were not strong enough at that point to surpass the last high, and this second demand zone cannot be trusted for a market context. The problem is that some traders will attempt to treat this second demand zone as a valid zone to go long, but that's a mistake since the buyers that created that zone are not strong enough. Even though it doesn't look like it, the demand in the first zone is a lot stronger because the buyers were able to create a higher high, therefore proving their ground against the sellers in the same flow. Let's observe what happens as price begins to retrace back to the demand zones. Here we can see how the second demand zone was indeed weak, as price went through it without even producing a bump to the upside. However, when price reaches the first demand zone, which is the demand zone that has buyers with confirmed power, price immediately reacts. There are two main indications for the reaction in here. The first is when price touches the inward frequency line and goes up immediately, and the second reaction is more mature because instead of reacting, price creates a very clear fractal bar, which you will observe all the time in significant market reversals. If you attempted to go long in the second demand zone that had unproven buyers, you would obviously be frustrated because the correct stop loss order there would be below the low that is part of the demand zone. However, by apprehending the general market context in this situation here, it's probably a good idea to go long in the level of the first demand zone because it's based on the action of proven buyers. And we can see price reacting in different ways to that level. Needless to say, there will be times where this will fail. The chaotic motion of the markets will guarantee that no matter how good your analysis is, sometimes it will fail. The point I'm trying to make here is that you have to pay attention to these subtle clues that highs and lows leave on the chart, so you can start forming the overall context of what's really happening between buyers and sellers. This is the core foundation for you to start trading correctly. Once you have this kind of analysis, then you can start thinking about the line work or some sort of technique to enter and exit the market. Many traders usually want to avoid this part and jump right to the enter and exit technique, which is a mistake, of course. Let's observe what happens after the fractal bar that touches the first demand zone. Here we can clearly see that not only price respected the more solid demand zone, it also created many more opportunities to enter the market on the way up by forming a smaller flow. More importantly, notice how the logical stop loss is respected in this case when we have a demand zone formed by solid buyers. In summary, not all supply and demand zones are created equal, so you must be able to identify the context in which they are created to decide about its future validity. If you want to learn how to trade using these and many other professional price action techniques, check out the courses I provide in the video description. You can also visit my website fractalflowpro.com to see the table of contents of each course and the testimonials from students who already use the techniques. If you enjoyed the material I create, please help support the channel by clicking the like button, subscribing to the channel, activating the notifications button, sharing the video, and leaving your feedback below in the comment section. Don't forget also to check the many other videos about trading in the channel. Thank you very much for watching, and I hope to see you in the next videos. Take care.